My namaskaram and greetings to everyone, Dr. Balal and other dignitaries online, Dr. Abhay Chandra sir and other dignitaries in the college campus, teachers who are present there, and students. It certainly gives me immense pleasure to be part of this session, especially in this month where we celebrate Teachers' Day. I'm here today not as a finance director of Johnson and Johnson, but more as an Indian citizen who has studied here, who has grown up here in a normal middle class background where my mom was a teacher, my father was a government employee, but leveraging the opportunities which this country provides and getting introduced to managing finances at a very early stage have reached a situation today where I'm able to pursue my passions and contribute to the society, not having to worry too much about finances. Doesn't mean I'm rich. It simply means that I have enough knowledge and skills to have the confidence that I can do well without having to worry about my job on a day-to-day basis. So with that, let me begin my presentation today. The agenda for today, we will cover what is financial freedom, why is it a desirable goal, how to achieve it, some of the key takeaways we will summarize at the end of the session, followed by Q&A if you have any questions. So what is financial freedom? We all have our wants and aspirations. Some of us want to purchase things, or indeed all of us want to buy, enjoy products and services. And oftentimes we feel we could buy more, and we should be in a position to buy as much as we want. So that's something which some of us really desire. Some of us are passionate about things which we care about, and we want to pursue these passions without any restrictions. Some of us want to serve the society, serve the community where we live in. And we are indeed wanting to put our energy in making the world and our country a better place. There are some of us who are not so sure what to do in life and therefore are still trying to figure out what we need to do. But wherever you are in this screen, financial freedom is important because it means not having any constraints to focus on really what interests you, whether it is gathering material wealth, whether it is pursuing your passion, whether it is serving community, or whether still in a stage where you're trying to figure out things. For all these things, if you're able to focus on it without any constraints, that means you have achieved financial freedom. That's a very simple definition. This is not a definition available on Google or anywhere. This is my own definition. You can always have your own definition. I'm here to just share what I believe is financial freedom. But the more critical piece of it is why? Why should you have financial freedom? Why is it so critical? I think this sentence which you see on the screen, which is an English translation from a Bollywood movie, I would honestly tell you, says some all sincerity and focus, the whole world conspires to make it. The word here is focus. The other pieces are very important indeed, but for today's session, I would want you to focus on the word focus, because you will be able to focus and do things if nothing is pulling you back. And oftentimes, what pulls many of us back are financial worries and constraints. So if you have a passion to do something and want to have that focus to do, it's very important that you have very limited financial constraints. And that's why it's important to be financially free as early as possible, or as early as the situation permits. Pathway to financial freedom. So typically, how does this pathway start? I'm talking about, in general, most of us, how does this come up? We all go to colleges, schools, and we gain valuable skills, which we're all doing today. And thanks to the teachers and lecturers and the college administrators who are helping us in this endeavor. I personally am thankful to my teachers who have made me capable and equipped to go out there and pursue what I really want to do. So gaining valuable skills is the first step, which most of you in that auditorium there are in the stage. The next stage is we go out, contribute skills to the society, and in return, we earn money. Now, this is key. And here I would say what Sanjay was mentioning earlier. In this stage, often the myth is that the more I earn, the faster I will become financially free. Not so. Historically, there are many people who have been very rich. There are a lot of sports people who have earned a lot in a short period of time. But because they earned but did not manage their finances, they went broke very, very quickly, right? So it's very, very important that not only we gain skills, we contribute to the society and earn some remuneration for it, but it's also very, very important that we invest very, very thoughtfully. This third piece is what is missing in the society today, and it's been the case for long, but things and situation is improving. But this is the most critical piece, and I'm here to share my views, thoughts, and inspire you to start thinking about investing thoughtfully right away as soon as you graduate from your programs. The key mantra for becoming wealthy or financially free is income minus saving is equal to spending. Notice that the common way in which we think is income minus spending is what I will save. But if you want to be financially free, it is important to tweak that equation a bit and put it as income minus savings is equal to spending. It means you earn your money, you have a plan to be financially free, you have a plan and a clear idea of how much you need to be financially free. So you keep it away to invest or save, whatnot. And the balance is what you spend, and you spend it without any guilt, without having any worries. So the key mantra, if there is something I would want you to take away from the session is income minus saving equal to spending is a very, very powerful financial mantra, which you should always remember. Now, in the previous slide, we spoke about investing thoughtfully. What exactly it is? It means putting your money into an asset which has a potential to grow. Later in my slides, I will explain each of these pieces. What are those assets? What do we mean by growing? And so on and so forth. But for now, the definition of investing thoughtfully means that thinking about where to invest your money, in which instruments which have a potential to grow. But before that, why should you invest? Or what is the difference between saving and investment? Are two critical questions which we will answer now. On this table, I have tried to explain what is the difference between saving and investment. Saving is a passive activity. You get some money, let's say you have 100 rupees as a very simple example. You put it in your pocket, and you go through your day-to-day thing, and months pass by, years pass by. One fine day, you remove that 100 rupees from your pocket, it is still 100 rupees. You have saved 100 rupees, but it's remained 100, which I know most of us don't do. We take the money, we put it in the bank. The bank gives you around 4 or 5% of interest, which is a passive way of saving in the bank account. And that over a period of time, in this example, 5 years, it will make 100 rupees into 128 rupees. However, if you invest, if you understand where you can put your money safely with an intention to grow, you can earn more than 5%. And let's say you earn 10 to 12%, then at the end of 5 years, you will have 176 rupees. That's a big difference. 176 versus 128. So saving is important, but more important is investing rightly so that you have your portfolio or your amount which you have with you, it continues to grow. Some of you may ask, I had 100, I'm getting 128 after 5 years. I'm okay. Why should I invest? Which is a very good question to ask. Why should you invest? And why should you invest more than the 5% which you are getting in a savings bank account in any bank in India? So that is a question we will answer on this slide. Many years ago, if you are able to buy certain items, a basket of groceries for let's say 150, today, if you want to buy the same thing, you have to pay 200. So the world is moving on. Whether you invest, whether you don't invest, prices will continue to rise, especially in a growing country like India. And by the way, it is good that prices rise because all of us then will have an incentive to go out there, work, earn. And that is how the whole country will get developed. And we will be able to pull a lot of people out of poverty. Inflation in a controlled manner is good. What I'm speaking here is inflation, which means rising prices. Controlled rising prices are good. It is a fact of life. And for a country like India, which is growing, it is indeed necessary, provided it stays within a certain range, which our government at both country and state level are always endeavoring to do. But inflation, you can also look at it in a different way. A few years ago, if for 150 rupees, you were able to buy 3 burgers, I have taken burger as an example because I don't know about you, but I enjoy burgers. Hopefully you also too, in a limited, quantities, of course. But a few years ago, at 150 rupees, we could buy 3 or 4 burgers. Today, you go to a mall or a place for 150 rupees, you just get 1 burger. That's another way to look at inflation. Over a period of time, for the same amount of money, you will be able to buy less and less. Investing will make sure that the amount which you have with you continues to grow and beat this inflation so that your money is able to buy at least the same amount which it is able to buy today. And this is a fact of life. None of us can change it. Inflation will be there. It's a fact of life. So the important thing for us is to know about it, to acknowledge it, and to take action so that we beat inflation. So the question is how to do it and what exactly we need to do. Let's switch gears and talk about some mathematics, because the mathematics is critical for financial freedom. By mathematics, I don't mean high-end mathematics. If you have enough knowledge of 10th class mathematics, you're good as far as managing personal finances is concerned. One key item out of your whole mathematics syllabus from class 1 to class 10, which you should always remember and never forget, is compound interest. It is considered the eighth wonder of the world in the field of finance and investment. Let me explain you with an example. Here is a table on the right. Let's say you have an amount of money. In this case, I have taken 100 rupees as an example. And you have two choices. Either to put it for simple interest or put it based on compound interest. Simple interest means that you put the money, let's say in a bank, it pays you interest, let's say at the rate of 10% for this example. At the end of the year, you will have 110 rupees. You take the 10 rupees of interest and put it in your pocket. The bank still has 100 rupees. In the second year, they will pay you another 10 rupees. You take the 10 rupees, put it in your pocket. Now at the end of 2 years, you have 120 rupees in your pocket. The third year, the bank again pays you 10 rupees. You take it, you put it, you get 130 rupees. That's how simple interest works. The bank has 100 rupees. Now in your pocket, you have 30 rupees. That's simple interest. In compound interest, the key difference is you don't take that interest and put it in your pocket. You keep the 10 rupees in the bank. Let the bank pay you the 10% interest on 100 rupees, which is your initial amount, and the 10 rupees, which is the interest for the first year. So in the second year, you earn 11 rupees. I'll pause for it to sink in. In simple interest, 10 rupees. In compound interest, you get 11 rupees. It is a very simple example, but many of us forget about it as we become busy in our day-to-day life. That's why I'm sharing it with a very simple example. In the third year, the interest becomes 12.1, and cumulatively at the end of 3 years, under compound interest, you earn 133 rupees and 10 paise versus 130 rupees which you had for simple interest. Now, just as a 100 rupee example, this may look very small, and that is okay. But what is important is, as the time expands, I would request you to focus on the graph at the bottom left of my screen. On the x-axis, you have the year plotted. On the y-axis, you have the amount plotted, which is the interest amount. If you notice, from the first year, second year, third year, the difference between simple interest and compound interest is very small. That's how mathematically it works. But as the number of years go by, look at year 10, 12, 15, there is a huge difference between simple interest and compound interest. The moral of the story is, if you keep your money long-term invested, it will grow huge versus trying to take away, every year. Doesn't mean you should not take away, because you will have some needs and wants over a period of time. But how to do it, we will come to it later. But one fundamental piece here is compound interest is extremely powerful. I have experienced it myself. I have seen many of my friends, colleagues, and students experience it. What I would want you to do is to experience it yourself at the end of the session, or later in the day, or tomorrow is a Sunday. The table which I show there with 100 rupee example, I would request you to just continue it beyond 3 years until 15 years. And you see how the calculation comes up and the difference you will see in the compound interest and simple interest. That should be an aha moment for you to say compound interest is really wonderful, right? Okay. So
Ravi,
let's take a real. Yes,
Ravi,
hi,
can I
Sanjay.
interrupt you for a second?
Sure, sure.
Do you want to switch off your video? Because from your side, internet is a little slow. If you switch off your video,
Okay.
probably your voice will travel seamlessly.
Sure. Is it okay now? Sanjay, are you able to hear me?
Yeah. You can continue.
Okay. All right. So let's take an example of how compound interest works and how it works wonders. If you start early, you are in a very early stage of your financial journey. This is the time to start. As soon as you start earning, if you start early, you will really do very well. Here are two examples: Mr. Joshi and Mr. Das. Mr. Joshi on the left starts investing at age 25 with around 6,000 rupees, and he increases his investment by 10% annually. Whereas Mr. Das starts a bit late at age 40, but starts with a higher amount of 15,000 and keeps increasing it at 15% annually. There's a huge difference in what Mr. Joshi earns and Mr. Das earns at the end of the period, which is 35 years for Mr. Joshi, and Mr. Das has invested for 20 years. You would see at the bottom of the table, Mr. Joshi has earned 105 lakh, or nearly a crore, and Mr. Das has earned around 40 lakhs. So as the time horizon shifts, the one who is investing early starts making a lot of money purely because of mathematics. It's all compound interest and nothing else. So the question is, okay, we understand investing is important. We understand long periods of time. But the next question is, where should we invest? This slide takes you through the various asset classes which are out there and which you can leverage. First is cash. The key characteristic of cash is that it has liquidity and it has the power to buy anything which you need immediately. Examples are currency in hand, savings in bank account, online wallets like Paytm or PhonePe and so on, or liquid funds. But the expected returns here are 0 to 5% only because they give you liquidity, flexibility to take out the money as and when you need. The next is fixed income. Fixed income means you lend the money to earn from it some interest. Examples, common examples, fixed deposits, bonds, or provident fund, which an employer deducts, from employee salary every month. Debentures, endowment policies, these are terms you would typically hear. These are a means of for you to lend money to someone and get interest from them. Typically, the expected returns are around 5 to 10%. Advantage is you get higher than the savings bank account interest. Disadvantage is it's only still 5 to 10%, which maybe inflation will eat away. But on the other side, the advantage is you can always withdraw if suddenly there is a need for you or for your family. The third one is commodities. Commodities speaks to ownership of items which are bought or sold widely. Common examples are gold and silver, crude oil and gas, rice, wheat, memory chips, and so on and so forth. Here, they earn up to 10%, but the challenge here is the returns are very lumpy in the sense, in some years they give you good returns, in some years they don't. But that is the nature of that asset. The next example is real estate, the next asset class. Real estate, as all of you may have heard, it refers to ownership of physical space directly or indirectly. Examples are farm, plot, or apartment which you buy, flat which you may buy, shopping mall units if you are into commercial business, or real estate investment trusts. Here you would earn about 20%, but again, there are a lot of factors involved in real estate. It has to be a good location. You should be able to buy and sell. There is maintenance cost involved. So there are quite a few things when it comes to real estate. The last piece is equity. Equity means you take ownership in a business either directly or indirectly. So owning a business directly means you start a startup company. So you're owning that company. You buy shares of companies. You buy ETFs or exchange traded funds, or you buy mutual funds. Here, the returns can go up to 30%. These are just indicative examples. But here, the essence is they can vary a lot in the short term, but they will earn you a lot in the long term. So if you're looking at making good amount of wealth, equity is certainly something which will be helpful over a long period of time. And if you're starting just now and you don't know where to go, a good mutual fund is an index mutual fund. An index mutual fund is a mutual fund which invests in index or indices. For example, Nifty 50 or Sensex, of India. These Sensex and Nifty are representatives of the entire stock market. So the entire stock market has got, let's say, 5,000, share companies. The index invests in top 30 or top 50, and they represent the entire market. So that is an index mutual fund. It's a good place to start. It's a safe place to start, especially when you are new and you don't know too many things about investing. But the critical piece is diversification. Just because an asset class gives you a higher amount of return, if you put everything in one basket of that particular asset class, let's say you take all your money and put it in equity, there are two problems. One is stock markets are volatile. So you put it, it goes down, there is a chance of losing a lot of money. Secondly, if you need something urgently, putting it in stock market is not a great idea. So it's very important to spread your money into all these portfolios: savings bank, fixed deposit, gold and silver, real estate, and equity. How much in each of these is something which is an art and a science. and it will certainly take more than a session to go into it, because it is very individual and very personal. It differs person by person. A person may say, I want to put a lot of amount in equity. The other person may say, I want to very small amount of money in the stock markets. And everyone is right? I'm not judging who's right, who's wrong. It is just that the way you invest and the time period which you invest and why you're investing will tell you where to invest and how much. So therefore, it's very important to sit with a financial planner or learn on your own and do portfolio diversification. The beauty of diversification is it covers risks and it also gives returns. Because remember, each of the asset classes which you see on the screen, cash, fixed income, real estate, equity, commodity, they all have risk and returns. The only piece which is safe is cash. You put it in your pocket or you put it in a bank, but it earns you very little and you will not be able to beat inflation. That is a problem. Equity is very good. It gives you, returns over a long period, but in the short term, it can go up and down violently, and it can, really, really influence how your portfolio looks or your total amount looks in a short term. So every asset class is good, but every asset class has a challenge. So it's very, very important to balance how much of each you need to keep in your portfolio. And that is where portfolio diversification comes in. So the key takeaways from what I shared today is financial freedom will help you pursue your passions. You don't have to worry too much about financial constraints. It will give you then, focus to really, really, do things which really interest you, for which you have passion. Investing thoughtfully over a long period will help you beat inflation very, very comfortably. Earlier you start, faster, you will achieve your financial goals. And you are very well placed as students who are, studying or will be graduating soon, to start thinking about it, how you will invest as you go out there and, make your mark in the corporate world or elsewhere. And how do you then plan to invest your money? Key mantra: income minus saving equal to spending. Compounding is the eighth wonder of the world. And the one who understands it earns it. The one who doesn't understand it pays it. For example, credit cards are good. They're all there everywhere. However, they are good as long as you pay what you have spent on credit card on time. You even delay by 1 day, the bank will charge you interest, and the interest compounds. So if you understand compound interest, you will stay disciplined and you will pay credit card dues properly. If you don't understand it, you will keep paying huge amount of money as interest to bank. So therefore, we say that compounding is the eighth wonder of the world. The one who understands earns it, and the one who doesn't, pays for it. And equity is an asset class which traditionally has given higher returns over long periods. India is a growing country. It will continue to grow. It will continue to be on the path for a developed economy. And therefore, equities are expected to continue to grow. But as you start, a very safe space is to look at index funds, which come with limited, risk, but good enough return. And then, as you increase your knowledge, you can look at other areas in the equity space. I have shared what I have learned in my journey over many years. Some of the resources which I always look up to are the ones I have listed here on the screen. I have benefited a lot, so I am paying it forward by sharing these resources with all of you. I wish you all the best as you begin your financial journey, and thank you for inviting me to this amazing session. I apologize if there was any challenges in hearing or seeing me because of any network issues. Thank you.